getting away from the dollar. Joining me live now to discuss it all, the founder of Sawchuk. Well, Terry Sawchuk in Southeast Michigan. Terry, good to see you.
Steve, good to see you, buddy.
So, all right, educate us a little bit. Play the professor, would you please? Tell us about the dollar. Weak dollar, strong dollar. What does it mean? We're the reserve currency. If that goes away, what does it mean? What does it mean for my savings, for my earnings? Help us out here, Terry. I feel a little bit in the dark.
I think there's a lot of nice little storytelling going on about the dollar right now, Steve. It's actually been pretty strong, and it's likely to strengthen, at least in the short to intermediate term. When they talk about the volume of trade, I mean, the US dollar is far and away the most used currency in the world. The next closest is the euro dollar. But to put it in comparison, about 60% of the trade settles in US dollars, about 20% settles in euros. The next closest one is less than 5%. So there is no other currency that is even remotely close to replacing the US dollar anytime soon.
Well, you know, from the late 19th century till about 1950, the sterling pound really was the reserve currency of the world. And then we made a deal at Bretton Woods and put the American dollar in as the reserve currency for the world. We made a deal. But for Britain, man, those next 10 or 15 years were not good. It was kind of ugly, frankly. And so if there is a shift that comes like that, it really can have a detrimental effect on, well, you and me and everybody in this country, couldn't it?
Sure, but again, you can talk about one piece, which is maybe it's not the dollar, but you can't have that conversation without talking about the other side and saying, what's it going to get replaced with? And there's nothing, right? So look at Russia. Russia's economy is completely based on exporting natural resources, oil, natural gas, and then some wheat, okay? They're a third world country. By the way, they're a communist dictatorship. China has capital controls. It's another Chinese dictatorship or communist dictatorship. They don't trust each other. None of the world trusts either Putin or Xi. So when you look at what's going to replace it, sure, other countries might, want to trade with one another for energy in particular, because they're trying to get outside, the sanctions of the United States. And okay, so maybe some of that happens, but the rest of the world, which is where the bulk of the money is going to trade in US dollars because we have the strongest economy, we have the strongest military, we have the strongest legal system. By every measure, the United States is far and away the place to do business.
So let me ask you about some other things that are going on. OPEC Plus says out of the blue, they claim out of the blue. I mean, you can see this coming. Obviously, Joe Biden has little influence at this point on what's going on OPEC, clearly, because they're cutting another million plus barrels a day. That goes with a cut that came in October. That drives up the price for the consumer. That drives up the price of gasoline. That drives up the price of diesel. That drives up the price of consumer goods on the shelves, which means inflation is going to continue. That's not good news.
No, I don't think that's an accurate assessment, Steve. I think the reason they cut, I'll tell you why. And I love you. You're a smart dude.
Well, I understand that, but I'm just saying, I'm not saying, why did they cut it then? Why do you think? So they can drive up prices for themselves and make more money for themselves. But the effect on us, what is it?
No, it's really just that the demand is falling. They recognize that we're going into a worldwide recession, that demand is going to fall across the board. So the more that they produce, the more they're going to have to lower prices ultimately. And I wouldn't be surprised if oil drops another $20. I wouldn't be surprised to see it back at $60 a barrel. You and I have been talking about this now, Steve, for 15 months. I told you that a recession was coming, and we're there. Okay, we are on the front end of this recession, and over the next 3, 6, 9 months, demand is going to continue to fall off the table. And it's smart business. And by the way, they front ran that trade. I mean, they knew they were cutting it, which is why oil all of a sudden went from wherever it was up to $80. But that's the last of it. I think you're going to see oil drop quite a bit over the next few months. And so I think it was a smart business move just to cut production.
We'll take a snapshot. West Texas Intermediate at this moment, $80.58. Brent crude exactly at $85. Both pretty even, very much flat for the day. But I've already seen the price of gasoline at the pump go up 40 cents in the last week or two, right? I mean, I saw it happen. That's why I say it has an impact on the American consumer, right?
100%, right? That's gouging, though. I mean, oil, they're not paying $80 for that oil. That oil is just coming out of the ground, right? It's not, this is oil. I mean, the gas stations are just taking advantage of the fact that it went up in price a little bit, but they're not paying more for it. The reality is that demand is going to fall off. We are, it's all tied together. We've talked about the banking crisis and how that's going to tighten credit. We've talked about, unemployment and how that the Fed is actively trying to increase unemployment. We're talking about how expensive credit is now. With a mortgage over 6% and federal funds rate at roughly 5%. All of that is going to take some time to work through the system. And by the way, they didn't fix the banking problems. All they did was stem the tide, but the small and regional sized banks, which is where most of the lending takes place anyway, they're losing assets left and right because either people are afraid their money's not safe and they want to put it with these GSIBs, the global systemically important banks like JP Morgan Chase or Citibank, or they want to go put it in a money market account where they're going to get 4 or 5%. Either way, these small banks are losing deposits. And all that the Federal Reserve did was give them cash in exchange for treasuries, but they lent it to them. They have to take that back at some point, and they have to pay 4.7% interest on the money that they're borrowing from the Fed so that they can turn around and give that money back to people who want to take the money out of the bank and put it somewhere else. They didn't fix the problem. So I've told you this time and time again, we are heading into a recession, and it's going to get pretty gnarly here.
A banking crisis as well? Is that what you're telling me? And the banking crisis is going to get worse because, I've heard a number of people say there'll be 4 banks left standing, really. The 4 big banks will be the ones left standing when it's all done. Yes or no?
No, I don't believe that. There'll always be some next level of banking, right? They're just not going to eviscerate the entire, small and medium-sized banks, but they're going to get consolidated. There's no question about that. I mean, that's kind of part of the process here. And because the small and regional banks is where a lot of the lending takes place, consumer credit's going to tighten. It's going to be harder to get a loan. It's going to be more expensive to get a loan. You're going to have better credit to get a loan. And the people who need it the most are the ones who are not going to have access to it, because their credit's likely, maybe not as good. And it's just going to create, a bigger problem. And the Fed right now is committed to getting inflation down, right? However, they'll only stay committed insofar as the rest
committed
of the
to a point, though, Terry, and I want to get this in before I let you go. Committed to a point. Are they going to raise rates again, or are they done? That's the real question, because I've seen people arguing both sides of it. I'll give you the last word.
The data right now suggests they should raise one more time. Okay. And what I'm saying is the data that they're looking at. I don't agree with it, but if you're looking at the data they're looking at, there's at least a 50% chance they're going to raise one more time. But the important part, Steve, is they're committed to keeping rates this way all the way through the end of the year. Now, their hand may get forced at some point, and that's what a lot of people are betting on. But if you talk to them right now, they have no intention of doing anything other than keeping rates high for the rest of the year.
All right. Terry Sawchuk, always appreciate it, and I'm glad you love me. I'm glad you put that out there for everybody. All right. Appreciate that. All right, my friend.
All right.
Thank you.
Happy Easter.
Happy Easter.